Hello and welcome to the live FX market analysis presented by OANDA. My name is Ed Moya. I'm a senior market analyst for OANDA, and I provide all my commentary and analysis also on the MarketPulse website. So definitely please take a look. Thank you all for attending. This is an interactive presentation webinar. So please definitely put in your questions. If you have any topics or specific currency pairs you want covered, be more than happy to address them throughout the presentation. And today's MarketPulse webinar will cover all the major topics from the trade war to what is happening with central banks, and also we'll touch upon Brexit and some of the emerging market stories that are really capturing some of the headlines. For those of you that are new to OANDA, you could see all of our analysis on the marketpulse.com website. You'll be able to access our Forex news, our economic calendar. You can read from any one of the analysts that we have working, which provides you round-the-clock coverage. I provide commentary throughout the New York session. My colleague Craig Earlham provides commentary for the earlier in the morning for the European trading day. And also, when you take a look at my Twitter page, you can see I post on Twitter pretty frequently. My colleague Craig Earlham, his hashtag is @Craig_Forex, and also Alfonso Esparza. He is my Canadian counterpart. We often work together. We will provide you with all the major updates, whether it is about the currencies, commodities, any major market moving event, you'll see it from us, and you'll also see us covering it on Twitter. And also over in Asia, Andrew R_Forex, that stands for Andy Robinson. He provides coverage throughout Asia. And also Jeff Haley is providing coverage. He is constantly being tweeted throughout the MarketPulse Twitter handle as well. So definitely lots to follow, and definitely if you are on social media, please take a look at us. You'll see we provide not just our links to our articles, but sometimes quick insights as to what is happening in the markets, and you'll be able to see that on an immediate basis. And just a quick little overview here. You see that at OANDA we have many tools. We have different trading platforms, and we also have OANDA Forex Labs. You'll be able to access a plethora of tools that could assist you in your trading decisions. So definitely take a look at that. The next thing I wanted to kind of quickly get into looking at charts and covering the big topics. I did cover a preview of the big events that were going to happen in August, and you know, not much has really changed from the beginning of the month. Everyone is still waiting for every incremental update on the trade war. And one of the key things that many people they get so fixated on the trade war between the U.S. and China, but the other important topic that kind of has fallen through the cracks is the trade war between the U.S. and Europe. And I think that you're going to see that's going to become a big focal point in the coming weeks, especially this weekend, because we have the G7 summit in France, and you're going to notice that trade is not on the agenda, but they're going to have one-on-one meetings. They're going to discuss trade. Obviously, President Trump is going to start his posturing, and he'll try to make things a little interesting, because he'll try to pit Germany versus France. Each has different objectives, and it will be a key story that you'll see definitely weigh on the overall risk appetite for not just the Forex market, but also on equities and all the other major asset classes. I think one of the big themes has been central bank easing. We've seen, for the most part, all the major banks deliver rate cuts, signal more are coming, or respective governments are identifying that additional measures are being considered. So there's, you look at any data point, whether it's in Asia, Europe, or even in the US, things are softening. Germany is it's growing belief that they're going to enter in a recession. You're starting to see more bets that you're going to see the ECB come with more rate cuts, more programs to help this stagnating growth. And you're going to also see there's going to be a big focus on the trade war. So that's going to be the kind of the big wild card over the remainder of the summer. And many people are expecting this to drag out well into next year. And we'll touch upon that a little bit more further once we take a look at the charts. We can go over some of the currencies that will be most affected by that. Okay, great. And I think the main event for this week will be Fed Chair Powellman's speech on Friday at 10 a.m. It's going to be eagerly watched. It will look to see if he can confirm that we'll have that next rate cut in September. And more importantly, though, he is going to have to do a careful job as far as not being too overly optimistic as far as some of the recent data we've had. Despite this trade war, despite a disappointing earnings season, despite lack of investment from the larger corporations, the U.S. consumer is pretty resilient right now. And we've seen retail sales come in better than expected. We've seen the labor market remain strong, and even inflation, which has steadied. It did have a little bit of an uptick. So it is a big focal point for him will be about the downside risks, and that's the main reason why we're seeing the Fed become so focused on delivering more stimulus, despite the overall headline strength that we're seeing on a lot of the major data points. So let's take a look at just what we have left for this month. Some of the big events you could see. The focus this week is really going to be Jackson Hole. Powell speaks Friday at 10 a.m. We do have also some big PMI data also on Thursday that will kind of confirm the continued weakness we've seen in the Eurozone. I think jobless claims is going to be an important metric. It's a weekly release that will kind of highlight if we start to see any weakness in the labor market. Eventually, it is expected to. It is, the record long expansion cycle that we've had in America has been extremely impressive, and we'll start to see some of that when it softens in jobless claims. So that'll be a key metric to follow. And then the next week you'll see we have a plethora of data, just more indications as far as the overall outlook, and also with some surveys. And then more importantly, though, I think we'll start to get some of these second readings of GDP for the U.S. 2% growth is still pretty great considering what's happening in the rest of the world. But if we do start to see more softness, I think that'll cement further easing bets for the Fed. And right now, it's markets pricing in just over two more cuts this for the rest of the year. So there'll be a very data dependent Fed. Will follow these metrics. So we'll definitely see how that will keep markets guessing as far as what amount of stimulus to expect into these respective economies. Okay, and now we're going to switch off to the charts. Definitely, please let me know if you have any specific currencies or questions on the indicators or tools that I'm using. So bear with me while I change the screen. All right, so right now, everyone should see my US dollar chart. It should be a daily chart. If you could just confirm that, that would be great. Great, thank you. And all right, so Euro US dollar, it's probably the number one question I get asked. It is the kind of the go-to currency pair for many, most liquid. It provides you with, at times, some of the more exciting trends, but this year we've seen it stuck in relatively tight ranges. That first quarter was a historically tight range, and now we're starting to see the continued weakness in Europe start to weigh on the currency. I think when you take a look at the daily chart right now, you'll see, and on my chart I have three simple moving averages: the 50-day, 100-day, and 200-day. The 50-day is in purple, the 100-day in yellow, and the 200-day in the light blue, teal. And what you'll see is that recently we've had consecutive failed attempts at breaking that above that 50-day SMA. And that's been proven to be strong resistance. You can see that 110 has held throughout all the headlines that we've seen, whether it is the expectations of further um, easing from the ECB, whether it is the risks that Germany is going to have a greater recession than some are anticipating. The euro, has still held on to 110. One of the, I think, key technical indicators that some people are also focusing on is when we take a look at the, just a quick look at the weekly chart, you can see, and let me just zoom in real quick. Um, One of the some of the indicators that people focus on are candles, and right now with the uh, last week's very large red candle is potentially a bearish engulfing candle, and typically it's more significant if this occurs after we've seen a major price advance. So it's not necessarily the case here, but it is an engulfing candle, and this could provide some spot pressure, and just taking a look at what engulfing candle patterns have done recently, it has provided some pressure about 6 times since February of 2016. So definitely a key technical indicator. But until 110 breaks, I think you're going to see price action be a little bit thin here in the short term until we get to some of these major risk events. So possibly Jackson Hole, possibly if we do hear more about the trade war or other key themes. And right now, when we take a look at my chart, you'll also notice that I do have a couple drawing tools on the very left-hand side. You can see I have an X to A to B to C to D move, and this is a potential bullish Gartley pattern. Now, patterns are not a foolproof way of providing you with how the market is going to reverse. It's typically when you take a look at uh, the charts of the euro dollar historically, whether it's on the daily, the weekly charts, you'll see that you oftentimes will see these patterns be providing you with constantly occurring throughout all time frames, but providing you with potential exit and entry points. So this particular pattern, if it is valid, could identify a key reversal point. And right now, and one of the key aspects of the pattern is you take a look at where we have point D, and typically we like to have key Fibonacci levels highlight that point D. And right now, roughly the B to C move is possibly targeting that 161.8, the golden level for right around that 110 handle, and also to the X to A move is providing us with close to that 61.8 level. So there's a potential pattern here, and if valid, this could signal that we could see a bullish reversal. Now, as patterns work, they could identify a key turning point, but when patterns are wrong and invalidated, sometimes what that will do is that will let you know that there's going to be continued follow through on that move. So if this pattern is invalidated, so if 110 is completely taken out, it could mean that we could see much more downward pressure right towards that 108 handle, and I think things will get very interesting if we do see further weakness to 105. So that's one of the charts that we get asked most of our questions on. You could see 110 right now is key, and right now is as far as to the downside, and when the confluence of the 50-day and also the 200-day has been, let me switch to the daily chart to talk about the simple moving averages. The confluence for the 50-day and the 100-day correction is just right around that 112 level. So 110 to 112 key support and resistance levels right now for this particular pair, and we'll see that be what many people will kind of look to see if we could have range trading until we have a clean break of either area. Okay. I did have a earlier question on the South African rand, and it's a very interesting story. So emerging FX, sometimes people will like to have longer term positions. I've covered this one, written about it before. I think one of the interesting stories about South Africa is that it's when we take a look at their sovereign ratings, right now they've been downgraded at junk by 2 of the 3 major rating agencies. Moody's right now is the only one that has them in investment grade. And South Africa's rand has been getting pummeled against the US dollar, and a lot of it's because foreign investors are just getting rid of their South African bonds at the fastest rate that we've seen in quite some time, and this is because they're expecting a credit downgrade to junk. And this is typically, once if a nation loses their sovereign rating, then if they lose investment grade status, it spells disaster for their currency, and this is why we've seen the South African rand really weaken in the past weeks. And I think one of the key stories that you're going to see is that their next review with Moody's is in November, and there's growing speculation that we could see, because of the whole situation with Eskom, and the government trying to bail them out. That's the state-owned electricity company. It has to be saved, and it is very all these measures that they're going to put into and efforts to help save Eskom is just terrible for their credit rating. So everyone's expecting that Moody's is going to move before that November review. So this is why we've seen a lot of weakness here with this South African rand. And then I'm just going to kind of zoom out to the weekly chart, and one of the areas you can see, like this has been a very strong trend. We've seen price tentatively respect that 1550 level, and I think right now, you can see right around here, around that 1575 region, we do have some more resistance. But if things do get much worse, and right now it's hard to be optimistic about South Africa, I think the only thing that would derail the trend here is really if we had a dollar story that prevented it. So dollar rand is right now, if the bullish move does accelerate even further, I think we could start to see the 16 handle tested, and then 16.5 is where we might see a little bit of exhaustion on a longer term trend here. And typically, one of the areas that I like to use my Fibonacci retracements and drawing tools is to identify, where are some of the key confluence of Fibonacci levels, and right now it's right around that 16.5 region that you could see the formation of a potential bearish butterfly pattern. So you could see this be the first wing, this is the second wing, and for many of you, I know you've asked before in previous webinars. In September 10th, I will be doing a special just pattern recognition webinar. So really kind of diving into these specific patterns, what I like to, the time frames, how I draw them, so we could, just dig a little bit deeper. So if that is something you're interested in, that will be on September 10th, and you can just sign up for that. Follow me on Twitter. I'll be tweeting about it too pretty frequently until then. So South Africa's rand it's been a very volatile trade because of that whole ratings agency downgrade speculation that have them lose their investment grade status. So a very important story to follow if you're trading the rand. Okay, great. So the next currency pair, dollar yen. I think dollar yen has been it's been mainly the trade of risk on, risk off, safe haven flows. It has really, for the most part, seen quite a strong reaction to the trade war. I think we will. At times the correlation is really high with the S&P 500. You'll see that right now we are seeing a kind of dollar yen consolidate here. I think the key level right now when I'm looking at dollar yen, and when you look at this chart right now, 105 is screaming at me. It's really a major a support here for the currency, and I think we could see some interesting moves from Jackson Hole with dollar yen. I think there is a growing expectation that because of the downside risks, the economy, that Fed Chair Powell is going to, and he's been pretty stubborn. He's not wanted to go full dove here. He's, at the July 31st rate decision, he said it was a mid-cycle adjustment. He kind of refrained saying it was an easing cycle, and that really kind of took many by surprise. I believe that could be a policy mistake on his part because of just the global risks with the rest of the world. And I think when you have the bond market screaming and telling you that, driving the 10-year treasury, was at 3.25 not too long ago, and it's like almost half of that. That is something where you don't want to end up in negative rates. And I think that doing everything in their power to provide support for the economy, it's a lot easier to support your economy when you're still expanding versus waiting to have things be in a recession, then try to get things back on the right track. So Powell is going to have a difficult decision to make, but if he disappoints, and if he does not provide that kind of inclination that, okay, maybe mid-cycle adjustment was a mistake, maybe we are really going to see more rate cuts, and if he focuses on the recent uptick in some of the data points, then you're going to possibly see that be bullish here for dollar yen. You could see that provide a strong move where we could see that 108 region be tested. I think if if the doves happen, if we do see September cuts coming, we could see more things happening. And if it's a focus on the global downside risks and what policy tools will be used if we have things get even uglier, when we could see that 105 area breach. So it's been a very safe haven type trade right now, and I think that ultimately the dollar yen is going to benefit from once we do see some further trade progress. And if the I think expectations for a few more rate cuts in the next, let's say, 12 months is realistic. I think we could have one in September, one more in December, and after that, then I think we could see them have possibly one more, and then possibly be on hold and wait to see if the rest of the global economy rebounds, because right now the rest of the world is ramping up their stimulus. So it's more of a wait and see approach, but I think eventually we'll see dollar yen benefit from once the Treasury yields start to find some stronger support. You'll see dollar yen be possibly the return of the carry trade here. But for right now, definitely a risk trade, risk on, risk off here. So right now, 105 the key level to the downside, and I think 108 will be a good short-term resistance in the short term here. Okay, and the next currency pair I wanted to take a look at is dollar Swissy. This currency pair, and I'm going to save some time here. We're not really going to talk about the Swiss National Bank, the SNB. One of the reasons why I find this one so interesting in this current environment is that typically when we do have the Fed begin an easing cycle, dollar Swissy has provided some of the strongest reactions. So typically, Fed goes easing, we see the Swiss franc strengthen significantly, much more than the other high beta currencies. So if we do get more of that dovish feel from Powell, if he uses Jackson Hole to kind of be that platform to signal that we are going to see further rate cuts, we could see dollar Swissy here have a resumption of this pullback that we've seen that pretty much started in May and kind of accelerated once we did see that first rate cut at the end of last month. So to the downside, I think 9,600 is going to be your first level of major support, and then possibly 9,400 after that. I think there is possibly some expectations that if we are surprised that we could see that test, maybe not to parity, but probably closer to that 99.50 region, where we could see a test there. But ultimately, even if the Fed is stubborn, I think that they're going to be forced into more rate cuts. So I think that in the short term, we will see some enhanced volatility with possibly this week, the end of the week's events. But longer term, if we do see those rate cuts come into fruition, I think that the Swiss franc here could appreciate a little bit further against the US dollar. Okay, and next currency pair we're going to talk about is Aussie dollar. This one has provided many traders with an interesting, I guess, when you talk about the Aussie dollar, I think many people have focused heavily on China's growth and the effects of the trade war and the stimulative measures that we've seen the RBA have to kind of embrace, and right now the downward trend has been pretty pretty much firmly intact for most of the year, and even when we take a look at, since the beginning of 2018, we were not too long ago right around 80, and now we're closer to 65. So I think that everyone is expecting the possible dead cat bounce here and see some type of a relief rally, but it's a trade right now that the prospects, the short-term base right now for the spot market has been extremely pressured here to the downside. And if we do see further pressure, I think you're going to be looking at that 65 level as a more of a longer term area. I think the simple moving average right now, and let's just go back to the daily chart real quick here. You could see that on the simple moving averages, we're pretty far away from them. So 6,900 is the 50-day right now. Right now, everything has been trending lower. We've pretty much consolidated for most of the month of August, and if we do see some more optimism on the trade front and global growth concerns, I think that you could see Aussie dollar provide a little bit of a rebound here, but I think that from where they were as far as in their easing cycle right now, I think there's more cuts expected to come from the RBA, and this currency pair is only going to really see a strong rebound here if we do see the U.S. go full dove, and if we do eventually see trade war progress. And I think right now the trade situation has been extremely difficult to follow, mainly because it's all posturing. The president, even today, just saying he's not ready for a deal, but China is, and something could happen. They're right. Both sides are motivated. I think the president, eventually will agree upon some type of maybe extended trade truce or an actual trade deal, because if not, this is damaging global growth. And we could see with his decisions on Huawei and to extend some of these punishments to another 90 days because he doesn't want it to hurt the U.S. consumer. That is ultimately what he wants to do. He wants to win the re-election, and if this trade war continues into next year, we've already seen the yield curve invert. We already have have every reason to expect global growth to be weak. That his reelection bid, if he's trying to run on a strong economy, is not really going to be there come next November. So a trade deal is going to become more of a headache for him in his reelection bid. So I think you'll start to see further progress on that front. And I think many people forget, just a few months ago they were getting pretty close to a deal. So the trade deal could come out of nowhere. I think the Chinese, as far as whether or not they want to wait to see if they have if we do have a surprise and a Democratic candidate does become the next leader, it could mean a tougher negotiation stance for them. So I think China might just be happy with locking in a trade deal with President Trump. And many people forget that a lot of these reforms that the president has campaigned on, and whether it was IP, intellectual property theft, or opening up their markets, greater access to China, this is what China was going to do anyway. This was part of their longer vision. So I think there is a big opportunity there for both sides to kind of come out looking good on their respective ends. And if we do start to get more trade optimism, that will just only help some of the commodity currencies, and Aussie dollar could benefit on that story. And also you could see New Zealand dollar, which their charts right now are very similar. You could see that the weakness that we've seen with the Australian dollar is almost mirrored here with the Kiwi. So for the Kiwi right now, kind of holding on to that 64 handle, 63.50 next would be your next key support level. And that's kind of the January 2016 low. And then if we break that, then we go to the September 29th, 2015 low, which is 62.89. And for the Kiwi, consolidation is what we're seeing, and we could very well still see that be the case. I think to the upside, Kiwi dollar is going to provide us with some resistance right around the 65.87 level, which is around the August 6th high, and then above that, I think around 67.20, which is right around that July 24th high, would be the next major resistance level. Okay, and then next currency pair I wanted to take a look at is the British pound, which has provided. I think when you talk about the British pound, it's really just all about Brexit. It's all about how how great of a risk is this no deal Brexit, and right now, and this is one of the most difficult stories to cover in FX is Brexit, because no one knows exactly how this is going to unfold. I think the best way at looking at the British pound right now is, strategists are, everyone is saying that, okay, maybe there's a 20% chance that we could see a deal, maybe then 40% chance that Britain will actually stay in the EU, and then 40% chance that we could see an exit with no deal. Or it could be a third. There is the uncertainty is high, and why we're seeing cable trade on all these kind of no deal headlines is because it is a risk. We're pretty much near the referendum low. We're seeing markets be extremely cautious as far as investing in the UK, and I think that the job for Boris Johnson, and he's taken over negotiations with the EU, and he's pretty much in the same position Prime Minister May was, and she tried to organize a orderly exit from the EU, and she failed pretty handily, and Johnson is trying to renegotiate. And right now, the way this is going to probably pan out is negotiations are going to go down to the wire. So we'll see Halloween be an exciting time for covering Brexit, and the risks of a no deal Brexit are pretty high. And if the markets do get nervous enough, I think we could see 120 breached. 119 could provide us with key support. If we see any major concession from either side, which is not really realistic, I believe, right now, the Irish border is the key problem. And I think that when we take a look at the Irish border, I don't expect the EU to provide any olive branches to Boris Johnson, and he wants to do away with it. So when Prime Minister May was trying to push through her deal, she had the backstop in place, and that's why it failed. And Boris Johnson is trying to get rid of this, and it will. The impasse is here is really increasing the chances of no deal Brexit. So, you could wake up one day and see 120 easily taken out, and then you're going to be looking at a massive move where we could see 115 tested if no deal does actually happen. Some analysts are targeting possibly 105, and if we do see continued pressure here on the British pound, it can get ugly very fast. I think that everyone knows too that both sides are posturing. I think that it would really be crippling to the UK economy and also to the EU. And the matter is extremely complicated because of just the problems for the Irish who are in the EU, and it is going to go down to the wire, and that's why you're seeing all this enhanced volatility. So if we do start to get some further optimism here that the odds of the no deal Brexit are kind of waning, then possibly we could see in the short term, maybe that test to 124. But unless we see any concrete concessions, and the story is not even just just the no deal. It's so much more complicated because you'll have confidence votes against Boris Johnson, and is it going to be eventually Prime Minister Corbyn? There's just too many variables right now. But I think the way many are looking at British pound is trading it on the technicals, and as long as 120 holds right now, you might see investors try to see if we do eventually see a key range of 120, 120.50, and possibly towards that 122.50 for some time. So I think that the Brexit story is going to be very fluid, and you'll probably see both sides remain stubborn until we get closer to that deadline. And you know what, the big thing is too, in next month we'll have that confidence vote probably, and it will complicate the matter, and I think that eventually, though, you'll see if we do have a deal put in place, or if we do see uh, another referendum on the table, that could be extremely bullish for the British pound. So there is this strong belief that you could see 105 or as high as 134 but by year end because of just this Brexit uncertainty. So definitely a trade that many will try to capture some of the momentum once we have a clearer picture, but it will definitely be violent and very fast. So definitely follow. You'll see us constantly covering it on MarketPulse. So if you're a political junkie, you'll definitely love reading about it. And if you're just strictly technical, it will definitely provide you with some of the more volatile moves, I think, for the rest of the year. Okay, and I think we're going to be wrapping up in just a little bit. I just wanted to see if we have any additional questions with regards to my charts. I do. I have two indicators, the stochastics and RSI, relative strength, slow stochastics, with the chart patterns. A lot of the Fibonacci levels that I use for the expansions, the 161.8% Fibonacci expansion level, and also the 141.4, so 141.4 and 161.8. And as far as Fibonacci retracements, the 78.6. Actually, I'll just draw one so you guys could see it right on the chart. So for the Fibonacci retracement levels, the 78.6, 61.8, the 50%, 38.2, and sometimes the 23.6. All right, great. And if there's any other topics you guys want to see covered, otherwise we will wrap this up and I will see you next time. I'm glad to hear that. Let me see, I got a couple more questions in. Bear with me 1 second, guys. All right, I have a question on the German DAX. Bear with me, let me pull up the chart. And I think when you're talking about Germany, one of the areas that I think many people were really excited about is that when the government officials were kind of saying that they were going to run a small budget deficit, I think everyone just kind of got extremely um, excited that, oh boy, this is going to be this is the kind of the perfect scenario for you're going to have the ECB delivering cuts, you're going to have fiscal stimulus hitting the economy. It's just what they're considering. It's just and I think that analysts are going to criticize exactly how effective it will be. I think it's a step in the right direction as far as helping the economy. I don't think rate cuts are going to be doing it. When we take a look at the recent weakness that we've seen, I think the recession concerns definitely have weighed on the DAX. When we take a look at the overall trend, you could see that the bullish trend that we saw for most of 2019 was breached back um, at the end of last month. And if we do see further weakness, I think that the 10,800 level would be key support. I think the stimulus measures that we're going to see, not just from the Fed, but from the ECB, and then also from China, I think you're going to have a growing expectations that it is going to kind of soften the blow, but ultimately, I think Germany is going to trade as the trade war, evolves. And I think I'm one of the more optimistic analysts that will see, uh, you know, both more so on the U.S. Um, urgency in having this trade war end. And I think whether it's continued extensions of this trade truce, I think it's going to provide a strong opportunity here uh, for German growth to stabilize. So even if we do see a technical recession here in Germany, I do believe it could be short-lived, as I think we're seeing the floodgates of stimulus come everywhere. So longer term, I think that you could be, the bullish case for European equities is nowhere near as good as the one is for the U.S. But I think that the German DAX could provide a longer term a better outlook. But right now, it's still vulnerable to the downside. 10,800 would be some key support, and then if we did have further pressure, I would it would be surprising to see if we did see the lows retested of the 2019 lows, and then to the upside. When we kind of zoom back, you could see that we're not too far off from some of this record high territory. So it looks a little choppy right now, but I think that the political stories in the Eurozone are going to be also driving the moves. But just take a look at all the developments that we saw with Italian politics today. Conte and his government are just kind of handling his or saying he'll go through with the resignation, and it's just it's a mess. But it did not affect the euro. It affected Italian yields, but you'll start to see the German Bund is still heavily in demand, and I think eventually you'll see that be supportive eventually for the German stock market once we have more stimulus cemented here. Right, and let me just see if there's any other last questions. All right, great. Well, thank you all for attending. I wish you the best in your trading. If you have any questions, definitely feel free to tweet at me. My handle is @EdJMoya. And if you have any other specific topics you want covered, you can definitely just let us know. We're evolving our webinars and want to make sure we provide you with the content you need to keep you more informed. So thank you all. Wishing you best rest of the trading day or a good night, and we'll see you next time.